Hello, in today's video we'll be taking a look at the Thursday, October 16, 2025 trading session for the SPX CBOE index, and we'll be utilizing the day trading GPS SPX Daily Key Levels indicator, specifically the V2.0 version of the indicator, which was released a few weeks ago. Okay, so some of you may already be familiar with how this indicator works, but some of you may be watching our videos for the first time. So I will run through how this indicator works before we get on to the rest of the session. Okay, so the way this indicator works is it works on two different symbols, one being the CBOE SPX symbol on TradingView. So if you go to TradingView and you simply put in SPX for the symbol, and then you would look for the CBOE exchange version of that symbol, and that is the main official SPX index. It also works on another symbol, which is the SPX 500 8 cap Forex CFD. The difference in the two symbols is that one is a Forex CFD, in which you would just trade SPX through a Forex broker, much like you would trade Forex currency pairs or other indexes on CFDs. And whereas the SPX CBOE is specifically for trading SPX index options. So if you're, for example, trading on a Forex broker platform through MetaTrader or one of the other Forex broker platforms, or if you're involved in a trading challenge with FTMO, or you have a funded account with one of the trading challenge Forex companies, then you would use the indicator for trading the SPX 500 8 cap symbol on TradingView for trading the Forex CFD. Now there's another reason it works on two different symbols, one of which is the way TradingView PineScript works as far as coding of indicators is that you may or may not already be familiar with the CBOE SPX index, but it does not open until 9:30 a.m. Eastern New York time. So at 9:30 a.m. Eastern New York time, you will get the key levels for today's session from the indicator on your chart when it's on the CBOE SPX index. However, this indicator offers you the opportunity to see the CBOE SPX levels 30 minutes early and 30 minutes before SPX CBOE opens and you can see them at 9 a.m. and get a 30-minute jump on the session through having a second chart open for the SPX 500 8 cap, which we'll take a look at that chart real quick. Okay, so this is the SPX 500 on the 8 cap exchange, and you'll see here that now there's two tables on the screen. So these levels here are going to be specifically for this symbol, the SPX 500 8 cap, and this table here is the same levels that you see here for that symbol. However, there's a second chart table display here which will give you the CBOE SPX levels that will be effective at 9:30. However, when it's on this symbol, you're getting them at 9 a.m. So the reason that it has to be this way as far as getting the levels early for the CBOE SPX is because the way TradingView PineScript coding works, if a specific symbol is closed, if the market's not open for it, if your indicator already knows what the levels it's going to plot for that indicator for that day are, they cannot be plotted until there's activity on that chart. So on the first tick at exactly 9:30, then you will get the levels on your CBOE SPX chart. If you want to see them 30 minutes early to get a jump on the session and perhaps do some trade planning, then you can utilize this indicator on the second chart on this symbol, and then you can get the levels via this additional table. Okay, back to the main chart here. Most people do use this indicator for trading SPX index options as opposed to the Forex. There's a lot more people that trade SPX via index options. So with this indicator, when it's on the CBOE SPX symbol, then you will get the levels on your chart for today's session at 9:30 a.m. on the first tick of that market open. The most important level that you will have of all the key levels is going to be this level here, the SPX Bull Bear KPL, which stands for key price level, which for today's session was 66.9837. So after analyzing recent days price action as well as overnight and pre-market action in the S&P 500 futures, as well as current market dynamics and market volatility, the indicator's algorithms will analyze all of that and come up with today's bull bear key price level, which is the all-important bull bear pivot for today's session. So tomorrow, the next trading day, it will do that process all over again automatically, and it will give you the new fresh levels for that day's session tomorrow at 9:30 a.m. Eastern New York. So these levels are specifically for today's session. So this indicator is made for intraday trading only. It's not meant for swing trading. So no matter what kind of option strategy you're employing, it is meant for opening and closing positions all within the same session. Okay, as you can see, we have it on a 2-minute chart. This indicator works on chart time frames from 1 minute to 30 minutes. If you put it on a time frame over 30 minutes, then there will be a message that will come up on the chart telling you to change your chart time frame to somewhere between 1 minute and 30 minutes. As far as intraday trading, as far as the strategy that we're presenting in this video, which is the same strategy that we have presented in all of our previous videos, this strategy is for trading calls on bullish signals and trading puts on bearish signals. So these are straight calls and puts depending on what type of signal it is. These are not, the strategy we're presenting is not iron condors or butterflies or any sort of combination or spread trades. Now we do have people that do utilize this indicator for those types of trades, and they will typically use it on a longer time frame such as 10 minutes, 15 minutes, or a 30-minute chart time frame for their process and their strategy in employing those types of option strategies. But for straight puts and calls, which is the main strategy that we use it for, the ideal time frame that we have found for utilizing this indicator for that type of strategy is the 2-minute time frame. So you may find that if you're using this indicator that a different time frame works better for your purposes and your particular strategy with this indicator, but we have found the 2-minute, and that is why you will see the 2-minute chart on all of our videos. Okay, so what are these other levels? Well, above the bull bear KPL level, you have the R1 through S1 levels, as well as below the bull bear key price level, you have the main S1 through S6 levels. So the main bull bear key price level, that is the main level, and these R levels and these S levels are also considered main levels. So with this indicator, you can take trades off of any of the main levels, so not just the bull bear key price level. And there will be a section at the end of this video. If you've seen some of our other videos recently, it's the same section that we've had at the end of those. So if you don't want to watch it again, you can skip it. But for those who haven't, we will have a 25-minute section appended to the end of this video, which will go over how to take trades off of the other main R1 through R6 levels and S1 through S6 levels as the session progresses, both bullish and bearish trades. And it will also go over the two different types of trade entries, one being the standard trade entry to use with this indicator, and the other one being a more conservative trade entry type, which requires additional confirmations. So that will be the last 25 minutes of this video. Most of the time during the opening moments, excuse me, during the opening moments of the session, especially the opening candle of the session, most of your trades will be derived and triggered from the relationship of those candles to the bull-bear key price level, because it's early on in the session. So that will happen in about 90 to 95% of your sessions. But as the session progresses, then other levels come into play. So it's also important for you to watch that part of the end of the video, which goes over how to take trades off of the other levels as well. Okay, so you have the main R levels above and the main S levels below. You also have these midpoint levels and these QL levels. So what are the midpoint levels? The midpoint levels serve several different purposes. First of all, the midpoint levels are simply the midpoints between main levels. So for example, here we have the mid BBKPL R1. That is the mid level between R1 and the bull bear key price level. Same thing below. The mid BBKPL S1 is the midpoint level between the bull bear KPL and S1. This mid S1 S2 is the midpoint level between S1 and S2. This one down here, mid S2 S3, is the midpoint between S2 and S3. We don't have the midpoint up here turned on because of the way the session turned out. There was no reason to turn that level on. And but if we did, then it would be mid R1 R2, and it would be here. The midpoint levels serve a couple of other purposes. One, which is for gauging continuing momentum, and they are also markers for half point levels in determining exits once you've exceeded on regular trades, which will explain the difference between regular trades and scalping trades here in a few minutes. But once you exceed a certain amount of levels, then each of these midpoint levels, when the trade is moving in your favor, also become decision points for exits and or adjusting your stop losses. The other thing that the midpoint levels serve is they serve as standard stop loss levels depending on what type of trade you're taking, bullish or bearish, and the specific level you're taking the trade off of. So for example, if you have a bearish trade that is derived from an entry signal on the bull bear key price level, and it's a bearish trade, then your standard stop loss will be the first midpoint above the level you're trading. So in this case, it would be the first midpoint above the bull bear KPL. Conversely, if you had a bullish entry signal and the trade level that you were trading from was the bull bear KPL, then in the case of a bullish trade, your standard stop loss is going to be the first midpoint level below the level you're trading, the bull bear KPL. And that works the same with other levels as well. If you were taking a bearish trade off of the S2 level, then your standard stop loss on that bearish trade from the S2 level would be the midpoint level above. Conversely, if you were taking a bullish trade off of the S2 level, then your standard stop loss on that would be the first midpoint level below. Now, what are these QL levels? QL stands for quarter level. The quarter levels above and below each level are your tight stop loss levels if you prefer to use tight stop loss levels over the standard stop loss levels. In our opinion, it's better to use the standard stop loss levels in all the trades. However, that is completely up to each individual trader and how they like to define their risk profile on the trades that they take. The tight stop losses, though, are going to be more prone to getting stopped out, so you do have less at risk with them, but they are going to be more prone to getting stopped out. So you would use those exactly the same way. You can turn on the QL above and QL below above any main level. Again, the main levels are the bull bear KPL, as well as the R1 through R6 levels and the S1 through S6 levels. So here we have QL above BBKPL. That would be your tight stop loss on a bearish trade taken from the bull bear KPL level. Conversely, the QL below the BBKPL would be your tight stop loss on a bullish trade taken from the bull bear KPL level. These QL above and QL belows can be turned on in the user control panel on any other levels as well. And the default settings for the indicator when you're first using it show the following levels. So it'll show the PMH, PML, YDH, YDL, and YDC, which that's the pre-market high, pre-market low, yesterday's daily high, specifically the yesterday's RTH session high, YDL, which is yesterday's RTH session low, and YDC, which is yesterday's RTH session close. So on default, you have those levels on your screen. You'll also have the bull bear KPL, and you'll have R1 through R6 and S1 through S6. You will also only have two midpoint levels turned on by default, which is the midpoints above and below the bull bear KPL, as well as the QL above and QL below. All the other midpoint levels and all the other QL levels are optional to turn on from the standard default look of the indicator. However, in the user control panel, you can certainly change the default to your liking. If you prefer to see less main levels on startup, you can uncheck those, and you can also check off to enable other midpoint levels or other QL levels as you prefer. Now we do have a video which goes into all of the features and setup, as well as all of the inputs in the user control panel. This indicator has lots of other features that we will not be going over today that are found in the user control panel, and we talk about them in that video. If you would like to see that video, then you can send us an email at daytradinggps@gmail.com and requesting to see the features and setup video for this indicator, and we will send you the link to that. Also, if you do have an interest in purchasing this indicator in return for you taking your time for watching this video today, you can send us an email at daytradinggps@gmail.com to request a discount promo code for the indicator, and we will send you a promo code that will give you a substantial discount off of the regular price. Where you buy the indicator is, if you look in the description of the video, you'll see a link that you can use to go to purchase the indicator with the promo code that we will send you if you want to request it. Okay, so just a couple more things before we get into it. One is these two tables here that you see are optional. You can turn them off. They are turned on by default. You can turn them off. They're not really that necessary. Some people like having them on there, especially when maybe one of these levels is very close to another level, and they would just like to see the levels on this table as well, in addition to the line labels here. So they can be turned off if you prefer not to do that. Also, when you are using this indicator, as you can see here, even though we have a table down here with R1 through R6 and S1 through S6, we're not showing all the levels here. That's because we've expanded the levels out. So when you first open the indicator, the levels will be more squunched together. So you don't want to have that. You want to move your price axis here with your mouse so it will expand the levels out. Generally, when starting the session, you want to have a look that's say from R2 down to S2, and then move the or R3 down to S3, and then if price dictates that it's starting to go beyond those levels, then you can certainly adjust your chart to also have it also show those levels. But this way you have more of a granular view, especially for your stop loss levels here around the BBKPL. Okay, so excuse me. So first off, when you use this indicator, like I was saying before, you have the main bull bear key price level as well as the R1 through R6 and S1 through S6 levels. And during the first moments of the session, you're primarily focused on the bull bear key price level because that's typically going to be on, at least on the opening candle and the first few candles, where a price is going to react. And in those opening minutes, it's setting the bullish or bearish bias for the session. So as an example, in today's session was much like yesterday's session in many respects. So if you happen to see our video on yesterday's session, which was the 15th, you'll see that a lot of the price action today was very similar to what happened yesterday. So just like yesterday, the opening candle here, which we have marked off, the 9:30 a.m. opening candle, opened below the bull bear key price level, and it is contained below the bull bear key price level, meaning it did not cross up through it and then close below it. It stayed below it and also closed below it. Even though this is a green candle, it is still below today's bull bear key price level, so that is a bearish signal. Additionally, since the candle was fully contained below the bull bear key price level, that's also telling us more of a bearish bias for the whole session, unless things change throughout the session, which I'll get to in a moment as to what would make that bias change after starting here. Okay, so one thing to keep in mind is that there's no rule or in our strategy or obligation in the strategy that you have to take the opening candle trade. That's just part of the strategy that we employ. However, you can also wait till later in the session. I know that there's a lot of people that use this indicator that prefer, for their own trading purposes, to let the opening moments play out, and they prefer taking trades off of other levels, whether they're bullish or bearish trades, because it suits their strategy purposes better. So, but if you watch most of our videos, we are taking a trade off the 9:30 a.m. candle, but I just want to make it clear that that's not a rule that you have to take it. It's just that we found in our trading that it works best if we start off typically in 95% or more of the cases doing that. Now, there would be some times where you would not take a trade, regardless of how above or below the opening 9:30 candle is. So this would pertain specifically to the opening candle, and that would be if the opening candle is far below S1 or far above R1 and also closes far above R1 or far below S1, and we're talking about the opening candle, then typically you would not want to take that trade, because one thing is it is too far away from today's BBKPL, and so the stop loss that you would employ on either one of those trades is just going to involve too much risk. So at that point, you're better off taking a trade off of a different level and then wait to see how price reacts off either the R1 or S1 or one of the other levels that may be above or R1 or below S1. But typically you're going to find that most of the time it's going to be contained within, say, maybe slightly above or a little bit above the midpoint above, or right at or somewhat below the midpoint below. So what I was talking about earlier as far as passing on the opening trade, if it's exceedingly below S1 or exceedingly above R1 and stays contained above that or below this. Okay, so the opening candle here, like we said, it is opening below, and as you can see, it's not exceeded the S1, and it did not open below S1. It's within the normal range. However, it has opened below, stayed contained below, and closed below today's bull bear key price level. So that is your bearish entry signal for this 9:30 a.m. candle. Now, how do we take a trade from this candle? What is the process? Okay, so first of all, you have to remember that this trade is being derived from the bull bear key price level because number one, it is a open and close below it, and this is the 9:30 a.m. candle. So this is the level we're trading from. That's important for determining your stop loss as well as determining what option strike you're going to use. SPX trades in 5-point increments. So as an example, 6690, 6695, 6700, 6705, 6710, etc. So the standard option play for the bull bear key price level is you would pick the strike that is closest to today's BBKPL price. It's 66.98.37, so the 6700 strike is closest to that. This is a bearish signal, so that is a put option. So you would use the SPX 0DTE 6700 put option. Now, if you've watched our videos, you'll see that we focus on SPX 0DTE options. You can use 1 DTE option. I would not use anything that is further out than that because you have to remember that you're going to be opening and closing these trades all in the same session. Sometimes it may only your trade may only last for a few minutes. Sometimes it may last for a few hours. But you're opening and closing your trades within the same session. You're not holding these trades overnight because tomorrow we'll have brand new levels in a brand new session. So there's no reason to use any option that's going to be more than 1 DTE. If you want to take a look at how these trades would have worked out with a 1 DTE option used instead of the 0 DTE, then you can look at the different data boxes as we have here for 2-minute charts at these different times to see how the 1 DTE 6700 put would have worked out mathematically. Okay, so we have the 6700 put, and as we stated before, since this is a bearish play, the level that we're trading from is the BBKPL. On a bearish play, our standard stop loss is the first midpoint above, which is this level here, 67.0869, and then the tight stop loss is the QL above, which is 67.0353. As I stated earlier, it is our opinion, better to use the standard stop loss on your trades. However, if you prefer using the tight stop loss, then this does auto plot the tight stop losses for you. Okay, the entry price on this candle close, remember we're on a 2-minute chart. This is a 9:30 a.m. candle, opening candle. It closes at 9:32. We're waiting until the close of the candle to actually get in the trade, because we have no idea where this is going to close. It could very well open below and close above, and then we'd have a bullish trade if we're taking a trade off the 9:30 opening candle instead of a bearish trade. So that's why you wait for the close of the candle. Now, just to be clear, if this candle had opened above the bull bear key price level, but then crossed below it and closed below it, then that is still a bearish signal. Conversely, if this candle, like it did here, opened below the bull bear key price level, but then crossed above it and closed above it, then that instead would be a bullish entry signal. But here we have where it's opening below, it's fully contained below, meaning it never crossed above, and it also closed below. So that's a bearish entry signal and setting the bearish buys for the session. The entry price on the candle close was $19.43. So if you're not familiar with the way options work, then it's as follows. You take the price that you're paying for the option and you multiply it times 100, and that would be your cost for one option. So the cost of one of these put options is $19.43 times 100, so that's $1,943 for one option. If you were buying 10 put options, and it would be 10 times that, it'd be $19,430. If the price of the option was instead $19 even, and that's what you executed your trade at, then you're paying $1,900 for one option. Now, if you want to take a look at our other videos, we also go over in the other videos that we've made recently, we have part of the video that goes over how you can also use out of the money options if you prefer to use those, because they cost less than at the money options for the same trade. I'm not going to go into that in today's video. You can watch the other videos where we explain how you determine what the other two out of the money option strikes that you can utilize are from the level that you're trading. But I just did want you to mention that you can use out of the money strikes. However, there is a limit to how out of the money they can be, and there is a process for determining what the strikes would be as well, depending on what level you're trading from. Okay, so now we're in the trade. What about our target exits? The target exits depend on what type of trader that you are when utilizing this strategy. Are you a scalper? Then you like quick hits, quick in and outs, or do you prefer regular trades to let them play out to have more profit, and typically those are going to take more time than a scalp? So first off, when using this indicator, when you're in the process of getting used to it, you would just need to determine, do you prefer scalping or regular trades? So as you can see here, we've marked out the difference in the boxes between regular trades and scalps. So how a scalp is done with this particular indicator is that you are looking for a one level move for your 100% closeout of your scalp. You're still using the same stop loss options excuse me, that you would, no matter which type of trade you're taking, a regular or a scalp, you're using the same stop losses. However, your exit is completely different on scalping. So on scalping, you're looking for a one level move. How do you determine what a one level move is? You take the level that you're taking the trade from, the type of trade that it is, in this case bearish. So bearish, we're looking for downward price action, so we look one level down. One full level down is S1 from the level we're trading at. So we're looking for a hit of S1 to close out our scalp. When you're scalping, our opinion is that on scalps it should just be that you are closing out 100% of your contracts. It doesn't matter if you're trading one contract, 3 contracts, 5 contracts, 10 or 20. You would, if you're scalping only, then when it hits the target, then you are out 100%. There's no adjusting your stop loss. There's no partial scale outs, and then let's just see if we can have a few that move down further. That's just our opinion on how to do scalping with this particular indicator. If you have a different process for your scalping, then that is up to you. You can certainly use if something's already been working for you. In other things, as far as maybe doing a hybrid system or something, then you can certainly continue to do that. It's up to every trader to decide their ultimate risk profile and how they manage their trades. But in our opinion, it would be 100% closeout off of a one level move. So here at 10:12 a.m. candle hits the S1 level here. So it goes down, it does touch this level, and it backs off of it slightly. At the time it hits this level, it's a one level move from the level that triggered entry, BBKPL, to S1. The 6700 put option price on the close of this candle is 31.20. Now the price was higher when it touched it, but we're just going off the candle closes. So the candle close is $31.20. It did reach a high of 31.9, so that was reached when it was had this wick down below where it actually touched it. The profit on the trade is $1,177 for this scalp. You take that by taking the 31.20 minus the cost of the option. As you can see here, before this happened, this may look like it touches this QL above the tight stop loss, but it actually comes several cents short of that, so it did not touch it. And as you can see here, it did not touch the or breach the standard stop loss. So you're out here, no stop loss hit, and you have your $1,177 scalping profit per contract. On the other hand, you have regular trades. Regular trades require a minimum 1.5 level move as a minimum target to either close out 100% of your contracts or to scale out 70 to 90% of your contracts, and then if you're trading multiple contracts, and then adjusting your stop loss to either break even, which at that point you are changing from level-based stop loss to now price-based stop loss, which we'll get to in a second. So the main point I'm making at this time is if you instead were not scalping and you were doing a regular trade, you got stopped out on this trade. So since we trade on utilizing the standard stop losses, that's what we've done here, but as you can see, you also got stopped out obviously on the tight stop loss. Now this happened at 10:44. So if you were just scalping, there was no stop loss hit and you're just out of the trade. However, if you were taking a regular trade and wanting to see that minimum 1.5 level move, then you got stopped out on this trade and you have a loss. Now for stop loss purposes, we don't go on the close. We go on the worst case scenario as far as presenting in in this video. So we're just going to go on the low of the candle, which is the worst case scenario. You may get stopped out on a price that's better than 12, but we're just going to assume the worst case scenario, which is 12. So since you paid $19.43 and you're getting stopped out on 12, you have a loss of $743 per contract. Okay, so you're stopped out here. So when you have a first trade being a losing trade, there are a couple of things that you can do at that point. One way to manage your account, if you prefer this method, some people do, some people don't. One method is to just stop trading for the session and wait to the next session, whether you're going to trade the next day or you were going to wait a couple days, but just basically waiting for the next trading session to then have a new opportunity with new levels and a new session. The other way is if you're going to keep trading and your first trade is a loss, then you be more cautious on your second trade and requiring additional confirmation. Additional confirmation can be in the form of successive candles confirming the move, or a successful retest of a level confirming the move. And we will go over that in the last 25 minutes of this video, like I had said earlier, where we'll have a section on taking trades off other levels and also the two different types of trade entries. So we'll go over that in more detail in that particular section. We're not going to do it at the moment except to go over with this particular entry. So at 10:52 a.m. we have a confirmation, a second candle close below the BBKPL here on this really thin candle right here. We did get a cross below here. Now if you took a bearish trade on this cross and close below, that would be considered a more aggressive trade because we've already lost our first trade. So we're looking for a more cautious trade. So we're looking for additional confirmation. This is one form of additional confirmation. We have a successive close in the direction below. Now here, this is the same level that we used over here in the opening trade. It's a bull bear KPL. So this is a bearish trade. So again, we're using a put. We're using the 6,700 put, which is our standard at the money option, except this time we're paying less for it. The entry price on the candle close is $17.74, whereas over here we paid $19.43. It's the same stop loss as we used before. Why? Because it's the same level we're trading on, and it's the same type of trade, a bearish trade. So it's going to be the first midpoint above for standard, the first QL above for the tight stop loss. As you can see here, after we initiated the trade, it came close to breaching the tight stop loss, but it did come up short on several candles here, and it never breached the standard stop loss. Now if you missed this trade over here, let's say you were taking a break, you were having a cup of coffee or whatever, you had to answer the door or whatever, and you come back. Well, you also have another opportunity here. Let's say you missed this, you weren't at your screen, and now you see this. Well, now you have the same sort of confirmation. You have a cross below, close below, and a reconfirmation close below. So if you missed this over here for some reason because you weren't at your screen, you'd have another opportunity over here. Many days it doesn't work out like that. Once it starts moving, it just goes like it did here. Okay, so we're in at 1774. Remember we talked about the minimum 1.5 level move. So how do we determine that? The same way we did with the scalp, except now it's 1.5 levels instead of 1 level. This is the level we're trading from. This is one full level, and we go a half level below. That's the 1.5 level. So here on this 11:46 a.m. candle, as you can see, the candle right before it fell short of that. This candle actually went through and touched it, slightly wicked through it, and then bounced above. So this is your 1.5 level move. This is your minimum move, minimum trade target on a regular trade. So at this point, you're either closing out 100% of your contracts, or if you're trading multiple contracts, such as 4 or 5 contracts or more, then you would scale out 70 to 90%. Scaling out means closing them out. And so, for example, if you were trading 4 contracts and you sold 3 of them at this point, then you're closing out 3 of them, and then you're leaving 1 as a runner. So closing out 3 contracts of 4 that you traded is closing out 75%. And then you would adjust your stop loss on the remaining runner. So remaining runner, if you had 4 and you sold 3, you have 1 contract as a remaining runner. And adjusting your stop loss means, as we started, you're starting off with levels as your stop loss. However, when you do an adjustment, you do an adjustment based on price. So at this point, you would at least adjust your stop loss on remaining runner to break even. Break even in this case would be adjusting your stop loss to 1774. Or you would add a profit buffer above break even of somewhere between 10% and 15%. So 10% on 1774 would be about $1.77. You could round it off to $1.80, and so you would add $1.80 onto 1774, and then that would be your adjusted stop loss with a 10% profit buffer. If you did it with 15%, then you would just add 15% of 1774 onto 1774, and then that is your adjusted stop loss with a 15% profit buffer. Now, when you're doing your first adjustment, you don't want to add a profit buffer of more than 10 to 15% because the trade still needs room to breathe. If you're the kind of person that feels like you would need to add more than that, or you would only feel comfortable adding more than that, then I would suggest that you just close out all of your contracts instead of doing an adjustment. Because when the trades are first getting going and before they start really accelerating, you need to give it a little room to maneuver, because a lot of times you have this stair-step move down where you're not just going to get a move down that just continues down and there's no retraces whatsoever. So there will be some retraces, and the idea is that if you do have any remaining runners and you've adjusted your stop loss, that as the trade continues to move more in your favor and hits more and more levels, then you add more and more, and you can become more liberal. So you add more and more profit cushion if you're going to stay in the trade. At every level in your favor, there's a decision to make of either just closing everything out or continuing to adjust your stop loss and looking for additional profits. It's just that when you have many more profits than starting off with the initial one, then you can be more liberal as far as adding on a higher percentage because you have more profit built in. Okay, so at this point our close here is 34.80. As I mentioned, it did wick down, but it closed back up. It was sort of a small bounce off of this level. So as you can see here, it did wick through it a little bit. So the high was 38.6 on the lowest part of this wick here. So even though the close was 34.80, that's what we're going on. If you actually got out on the touch, you were probably getting out closer to 37. But we're going by the closes here on everything except for the stop outs. Any stop outs, we're just assuming the worst case scenario. Okay, So 34.80, profit 1,706. However, we did have a $743 loss. So now our net P&L after deducting that $743 loss on the regular trade scenario is now $963 per contract. So if you only have one, you traded one here, got stopped out, and traded one put option contract again here. Now you have a $963 net P&L. Of course, that doesn't include any commissions that you may have paid to your broker. If you traded 10 contracts, then you would be up $9,630. Okay, so as you can see here, I've also marked off the second scalp. So I wanted to go into the regular trade first to explain that, but now we're going to come back to this point. Here was, if you were just scalping, remember you had the scalp trade, there was no stop out, and if you're a scalper and you entered this trade again for entry number 2, then you would have gotten out on the one level move when it hit right here at 11:30, which was 16 minutes before it hit the 1.5 level. So one level move again from the level we're trading down to S1. The price on the close of this candle just happens to be by chance the same exact price that it was back here at 10:12 a.m. of $31.20. So it's the same $1,177 per put option profit. So the total P&L on 2 winning scalp trades with no stop outs is $2,354. So now we'll continue on with the regular trade. So here at 12:18 p.m. it hits the S2 level right here on this candle. So this is the ideal 2-level move for closing out 100% or scaling out 70 to 90%, adjusting stop loss remaining runners. The minimum on regular trades is going to be, your minimum target is 1.5 level move. Ideal minimum target is 2 level move. So on this candle close, now this candle closed through it, even though we do have this small wick down here, it did end up closing through it. So on this candle close, it's 47.77. The profit is now $3,003 per contract, but the net P&L after deducting the $743 is per contract is now $2,260 net P&L per contract. Okay. So at this point, when it hits the S2, you would do a further, if you have remaining runners and you're not closing out 100%, you are adjusting your stop loss as we talked about. Then, as you can see here, at 12:30, now we have the 12:30 candle hitting the mid S2, S3 level. So this is a 2.5 level move. So we have from the level the trade is derived from, down to 1 level, that's where the scalp only is. 1.5 level minimum target on regular trades. 2 level ideal minimum target on regular trades. And then here is the 2.5 level move. Because you don't really know how far down these trades may go. Now you can ascertain that this is the YDL level, yesterday's daily low. So one thing to keep in mind in the context of these other levels here, they're here for specific reasons because they help in the general context of being additional key levels that can help you in your decision making as well during the session. So this is yesterday's daily low. Oftentimes this is where a lot of moves will stop, a lot of down moves will stop at yesterday's daily low and turn around. As you can see, there's some confluence here between S3 and yesterday's daily low. As you can see later on, we did get a it did stop short of S3, but then later on We did get a trade through, and then a trade. We also got price to briefly go down and probably take out a whole bunch of people's stops that were down here who were holding positions from yesterday, and then we had a move back up. Okay, so back to this point here, 1230 candle hits the mid S2, S3 level. This is a 2.5 level move, 1 level, 2 levels, 2.5 levels. The 6700 put is now $66.60 on this candle close. This candle also closed through and below this mid S2, S3 level. So with 66.60, now our profit is $4,886, and our net P&L on regular trades now $4,143 after subtracting this loss here on the stop out. As you can see here, we have a brief reprieve here, stopping short of the S3 level, stopping short of the YDL level. We had a move back up to S2, but then we continued to move down further, and then we sliced through S3 here in the 2:10 p.m. candle, hits the S3 level, and now this is a regular trade 3 level move. 1 level, 2 levels, 3 levels in our favor. So again, another decision to make at each level. 100% closeout, scale out 70-90%, adjust stop loss on remaining runners. So as it gets down further and further in your favor, and you have already adjusted your stop loss back here on the minimum target, you can become a little more liberal as to how much you keep adding when it hits each additional target. Because as you can see here, you do get a strong retrace here, so that's why even though you have a soft adjustment of 10 to 15%, you want to keep that in mind, that you don't want to get too you don't want to add too much of a profit cushion if you really want to see how far low it may go, because you'll just end up getting stopped out. Because if you're going to put too much of a profit cushion in on your runners, then you might as well just go ahead and close them all out, because most often you're just going to end up getting stopped out, and you would have just been better off just closing all of them out. Now, as an alternative, you can just adjust your stop loss here instead of closing out 70 to 90%. So as an example, if you were just trading one contract, then your only thing that you can do is close it out. So if you're not satisfied and you have one contract and it's hit the minimum 1.5 level move, your choice is either, closing it out or staying in the trade. So if you don't close it out when it hits this here, and let's say you're trading just one contract, then you still want to adjust your stop loss with the same profit buffer. And then when it hits each succeeding level in your favor, then you have another decision to make. Do I want to close out now or keep adjusting my stop loss? So if you're just trading one contract, that's what you have to keep in mind, that it's basically all or nothing. So when it hits the minimum target, it's all or nothing. Either you're closing out or adjusting your stop loss, because you only have one contract. And then you would do the same as at each level, make that decision. Okay, so we went over this. So here, over here, we had the mid S2, S3, but now over here, the 210 candle, it hits the S3 level. It's a full 3 level move. Like we said, the profit 66.46. Now the net P&L after taking out this stop loss hit is $5,903 per contract. And here's the closing price here. So as you can see here, we did also hit the mid S3, S4 level right here on this wick of this particular candle, the 2:34 p.m. candle here. hits the mid S3, S4 level, that is now a 3.5 level move. Close out 100% or scale out, adjust stop loss, etc. And as you can see here on the candle close, now this candle did have a quite an upward thrust here after touching this mid S3, S4 level. So, but we're still just going to go, just to be consistent here, on the close. So on the close, it's $93.50, as I pointed out here. So the profit based on the candle close of $93.50 from our cost of $17.74 is $7,576. The net P&L on regular trades after subtracting out the $743 is now $6,833 if you were still in this trade. Okay, so here I've also pointed out that on the touch of the mid S3 level, it was, as you can see here on the low of this wick of this candle here, it reached 106.17. So if you actually got out on the touch of this level, then you would be closer to, say, probably $104, $105, $103 in that range. So then you would have another 1,000 or so in profit per contract. Okay, so now we've reached the point where we are going to go into the final part of the video, which I mentioned earlier, which is the 25-minute session, which is going to go over how to take trades off of the other main R and S levels, either whether they're bullish or bearish trades, what to look for, and also the stop losses to use, and then also the two different types of trades, your standard entries as well as the more conservative entries, which take additional confirmation in one form or another. So before we transition into that part, I'm just going to mention again that if you do want to purchase the indicator, you can send us an email at daytradinggps@gmail.com and request a discount promo code. And in return for you taking your time to watch this video today, we will send you a promo code that will give you a substantial discount off of the regular price for purchasing the indicator. And again, the link for purchasing the indicator can be found in the video description below the video. So we thank you for watching. If you're not going to stay on through the next part, then we thank you for watching today. We wish you prosperity in all of your trading. And please like the video and subscribe to our channel if you'd like to see more videos, as it helps us with the YouTube algorithm. Alright, so now we'll pause the video and then we will go into the next section. Hello, in this video we're going to go over how to take trades off of the other main R and S levels. So this would be taking trades off other levels besides the bull bear key price level. So the main R and S levels are your R1 through R6 and S1 through S6. So if we zoom out here, we'll have R1 through R6, S1 through S6. The levels that show up as default on startup with this indicator are the PMH, PML, YDH, YDL, and YDC. So that's the pre-market SPX pre-market high, SPX pre-market low, SPX previous day RTH session high, SPX previous day RTH session low, and SPX previous day RTH session close. So the previous days are YDH, YDL, and YDC. So that's yesterday's high, yesterday's low, yesterday's close. PMH and PML are the current session's pre-market high and pre-market low. So pre-market high, pre-market low, YDH, YDC, and we move down, here's the low from the previous RTH session. Also in startup, you will have R1 through R6, the bull bear key price level, and S1 through S6. You will also have QL above BBKPL, QL below BBKPL, the first midpoint above the BBKPL, and the first midpoint level below the BBKPL. And this is because in 95% of the sessions or so, your trades at the beginning of the session, if you decide to take trades at the beginning of the session, are primarily going to be based on price action at the bull bear key price level. However, there is no rule or obligation to take trades off the BBKPL. It is there for the session bias, to give you a bullish or bearish bias for the session, as well as the trades that you can take at the beginning of, like I said before, 90-95% or so of most sessions that you will see. However, you can just wait until price action bears out further on in the session and take trades off of the main R levels or S levels. As we've discussed in other videos, when you're taking a bullish trade off of the bull bear key price level, your tight stop loss is the QL below the BBKPL on that bullish trade triggered from the BBKPL level, and your standard stop loss is the first midpoint below, which would be mid BBKPL S1 for a bullish trade taken off of the BBKPL level. Conversely, on a bearish trade taken from the BBKPL level, your tight stop loss is the QL above the BBKPL, and your standard stop loss for a bearish trade taken off of this BBKPL level is the first midpoint above the BBKPL, which is mid BBKPL R1. The same principles applies to taking trades off of the other levels. So if you're going to be taking trades off the other levels, then you simply need to turn on the quarter levels if you're going to be considering taking tight stop losses, or the midpoint levels for standard stop losses. So for example, if we're looking to possibly take bullish or bearish trades off of R1 or R2 or S1 or S2, then we would simply turn on the QL levels above and below those levels, as well as the midpoint levels. So you simply go into the user control panel, and first we'll turn on the midpoint levels. So we'll enable mid R1 R2, mid R2 R3, mid S1 S2, and mid S2 S3. And let's say we're also considering tight stop losses. Then enable QL below R1 and above S1, below R2 and above R2, and then the same thing for the S levels. Above S1, below S1, above S2, and below S2. Now you can leave it this way if every day that you want to consider taking trades off of this level. Just know if you reset the settings, it's going to go back to what I showed you before as the default. So for example, right now we're just showing R3 through S3. So for example, if price is coming down to S1 and bouncing off of S1, and you want to take a bullish trade off of S1, then your tight stop loss on a bullish trade is the first QL below S1. because S1 is the level that you're taking the trade off of. And the standard stop loss would be the first midpoint below S1, which would be mid S1, S2. So instead of a bounce off of here, if price came below here, then went back up and crossed above and closed above S1, and you wanted to take a bullish trade off of S1, it would be the same thing. You're taking a bullish trade off of S1, so your tight stop loss is to QL below S1, and your standard stop loss, if you choose that one instead, is the first midpoint below S1, mid S1, S2. Let's say the reverse happened. Price is slicing through S1 and closing below S1. And you want to take a bearish trade off of S1. Then on a bearish trade from S1, your tight stop loss is the QL above S1. And on a bearish trade on S1, your standard stop loss is the first midpoint above S1. So always just remember that on bearish trades from any level, your tight stop loss is going to be the first QL above that level, and your standard stop loss is going to be the first midpoint above that level for bearish trades taken from that level. And on bullish trades taken from any main level, your tight stop loss is going to be on bullish trades taken from the main level, your QL below that level, and your standard stop loss is going to be the first midpoint below that, whatever level that is. So on R1, if we were taking a trade of a breakout above R1 and we're taking a bullish trade, then our tight stop loss is the QL below R1 because that's the level we're taking the trade from. And our standard stop loss, if we choose that instead, is the mid BBKPL R1 because that's the first midpoint below the level we're taking the bullish trade from, R1. If we were taking a bullish trade on a breakout above R2, then our tight stop loss in that bullish trade on a breakout above R2 is QL below R2, and our standard stop loss on a breakout above R2 is going to be the first midpoint below R2, which is mid R1, R2. Now, in the reverse, let's say that price goes up to R2, now it starts closing below R2, and we're looking for a bearish trade off R2 to move down below to these levels below. On a bearish trade from R2, then our tight stop loss is the first QL above R2. If we choose instead to use a standard stop loss for our bearish trade taken off R2, then the standard stop loss is the first midpoint above R2, which is mid R2, R3. Same thing if we're taking a bearish trade off of R1. If we're looking for a bearish trade off of R1 or break below R1 or a touch and fall off of R1, then our tight stop loss on the trade taken from the R1 level is the QL above R1, and our standard stop loss on this bearish trade taken from R1 is the first midpoint above R1, mid R1, R2. Same thing applies to the S levels on bearish trades. If you're taking a bearish trade based on price action coming down, closing below S1, then your tight stop loss in that bearish trade taken from the S1 level is QL above S1, and your standard stop loss is the midpoint level, the first midpoint level above S1, which is this mid BBKPL S1. On a break below S2, then a bearish trade taken from S2 is the tight stop loss for that. On a bearish trade taken from S2 would be the first QL above S2 here, and your standard stop loss would be the first midpoint above S2, which is mid S1, S2. Same thing applies on S3 levels. If this was a bearish trade we were taking because price started closing below S3, so in a break below, close below S3, our tight stop loss would be the QL above S3, which we don't have because we didn't enable it on this chart, but it would be the first QL above S3, or if instead you're choosing to take the standard stop loss for your trade on a bearish trade from the S3 level, then it's the first midpoint above S3, which is mid S2, S3. Same thing for a bullish trade above R3. Break above, close above R3, then your tight stop loss would be the first QL below R3 because we're taking a bullish trade looking for price to go up, continue going up. So you would enable QL below R3 if you want to use a tight stop loss. Keep in mind that if you're just using standard stop losses, then unless you have some reason why you want to see where the QL levels are, there's no reason to turn them on. So if you're just going to be using the standard stop losses, then you would just want to have your midpoint levels turned on, unless for some reason you also want to see, just for context, where the QL levels are. So again, in summary, if you're taking a bullish trade off of either the bull bear key price level or any main level, whether it's an R level or an S level, if it's a bullish trade, then your tight stop loss, if you choose to use that, is the first QL level below the level that you're taking the trade from, and your standard stop loss is the first midpoint level below the level you're taking the trade from. The opposite is what is on bearish trades. On bearish trades, then if you use a tight stop loss, then it's the first QL level above the level you're taking the trade from. If you're taking a bearish trade and want to use a standard stop loss level, then your standard stop loss level is the first midpoint above the level that you're taking the trade from, the bearish trade from. Bearish trade from R1, standard stop loss is mid R1, R2. Bearish trade off of R2, looking to go down, your standard stop loss is mid R2, R3. Bearish trade from the BBKPL, your standard stop loss is the mid BBKPL R1 because that's the first midpoint above it. A bearish trade taken from the S1 level, your standard stop loss is the first midpoint above S1. And again, on bullish trades, it's the opposite. It would be the first midpoint below. So if you're taking a bullish trade off of S2, first midpoint below S2 is your standard stop loss. Okay, so now we're going to take a look at examples of both standard and conservative entries, both on bullish entries and bearish entries. So first off, we're going to look at bullish entries. So here we have a cross above and close above. So we have a candle that the same candle is crossing above the level in question, in this case the bull bear KPL, but it would not matter what level it's on. So regardless of what level this is, you have a cross above and close above the level. That is your bullish entry on a cross above and close above the level in question. Your second option is take a more conservative bullish entry approach. And on the more conservative bullish entry approach, you are requiring a retest of the level, a successful retest of the level before entering your trade. So in the case of a bullish trade, you're waiting for a successful bullish retest of the level in question before entering your bullish trade. So on this more conservative option, the sequence is you have a cross above and close above the level, which we have here, followed by price falling back to test the same level, successfully, meaning it's coming back down, it's not closing below the level, it's successfully retesting the level and closing above the level. So it's cross above, close above, fall back to retest on a bullish trade, close again above that level. That is your conservative bullish entry that requires a retest. Just keep in mind that if you are going to focus and use the more conservative bullish entry that requires a retest, that many times price, after initially crossing above and closing above, will just continue to keep closing above in successive candles, and there will be no retest. So just keep in mind that if you use the more conservative entry, there are going to be times where you are going to miss entries because there is not going to be a retest. In this case, there was a retest. So again, just to go over it again, the standard bullish entry is a cross above and close above the level in question, in this case the BBKPL. So you would enter on the close of this candle here. Or if taking the more conservative bullish entry approach, you're waiting for a successful retest for price to fall back to the level in question, but still close above the level in question, and that is your successful retest. So you would enter, you could have entered on this candle, or if you did not on those, you could have entered on this candle here, and it did retest the candle here. We had a retest here, but if you waited for this retest, you'd be paying a lot more. So usually the successful retest, you're just waiting for the initial successful retest. So this is the initial successful retest. This is the initial cross and close above. This is the initial retest. Okay, so just to take this one step further here, so as you can see here on the R1 level, we had a cross above and close above this level. So if you missed this entry here, or if you're just the kind of trader who you prefer taking trades off of other levels besides the bull bear key price level, then you have a cross above, close above here, and you would take that entry here, and you would base your entry on the R1 level. Now, just to clarify, the stop loss on either one of these entries here, down here, whether you took this standard bullish entry or the more conservative retest required bullish entry, your standard stop loss is the first midpoint level below the level in question you're taking the entry from. So in this case, on this sequence here, this is taken from the bull bear KPL, so your standard stop loss is the first midpoint level below the level in question, the bull bear KPL, so that is this level here. We don't happen to have the quarter levels on this particular chart, but if you instead wanted to use a tight stop loss level, then you would enable the QL below the bull bear key price level, and that would be your tight stop loss on this trade. And the QL is the midpoint between the midpoint and the main level. So on the new version, the 2.0 version, you have the auto plotting of the QL levels if you simply enable them. But here, as you can see, the tight stop loss would not have been hit either. But just keep in mind that on any entries, whether it's bullish entries or bearish entries, the tight stop loss is named a tight stop loss because it is tighter and there's more chance that it will be hit than the standard stop loss. So if you're going to use the tight stop loss, you're going to have less at risk because you're using the tighter stop loss. But conversely, the con side of that is that there's more chance of it getting hit. So you just have to be mindful of that. If you instead, like the second point we're getting at, if you waited to take an entry off of the R1 level on this cross and close above, then your standard stop loss on that trade is the first midpoint below the R1 level, which is this mid BBKPL R1. And if you instead took the tight stop loss, then it would be the QL below the R1 level, which would be the midpoint between this level and this level, which again, on the new V2.0 indicator, those auto plot as well, the QL levels. Okay, now we'll look at a bearish entry. Your standard bearish entry, you enter a bearish trade on a cross below and close below level. So here we have a cross below and close below the R2 level. So you would enter a bearish trade on this cross below and close below if you were looking to take a trade off of the R2 level and you were open to bearish trades off of that level. This would be your signal to take the bearish trade on a standard bearish entry. Your standard stop loss on this bearish entry is the first midpoint level above the level you're taking the bearish entry from. Since the bearish entry is from the R2 level, your standard stop loss is the first midpoint level above the mid R2, R3 level. And if you chose instead to use a tight stop loss level, then it would be the QL above R2, which in this case would be about right here. And again, on the new V2.0 indicator, it will auto plot that level for you if you go ahead and enable it. Now, looking at the more conservative bearish entry, it's just like the bullish one that we did, except in reverse. We're waiting for a successful retest of this level before entering the bearish trade. So in this sequence, it's basically the reverse of this sequence down here for the bullish entry. In this sequence, we have a cross below, close below candle. Then price rises back up to test the level in question and then closes below that level again. That's a successful retest of the level. So this is where you would enter on a successful retest. You could have also entered here. That would have been a little bit later, but that, either one of these candles here would be considered the successful retest. So even on the successful retest, since it's off of this level, it's the same stop loss. First, for a standard stop loss, the first midpoint level above, which is mid R2, R3, that's the first midpoint level above this R2 level. And if you chose to use a tight stop loss, it'd be the same as what we talked about with the standard entry. It would be the QL above R2. And the same thing would apply for any other level. So if this price action was happening down here on this S2 level instead of here on this BBKPL level, then it would be the same sequence. Cross above, close above, that's your standard entry. Cross above, close above, then retest and close back above, that's your conservative successful retest entry. And then your standard stop loss on an S2 level bullish entry is the first midpoint level below S2, which is mid S2, S3, and then your tight stop loss level on a bullish trade taken from the S2 level is your midpoint, the QL below S2. Okay, I hope this clarifies the entries and also taking entries from the different levels for you. Thank you.